Is it time to buy tech? Have we worked through the valuation headwinds that a lot of people have talked about over recent months? And if we have, and you don't think it's time to buy tech, why not?
Yeah, yes, some of the valuation headwinds is behind us, but it's still a tough environment for tech when the Fed is still on a hiking path. And quite honestly, we're still seeing some weakness in the consumer segment of the tech, whether that's PC or smartphone. There's also concerns around semis, and over-ordering in some of those areas, and then concerns within software and the pull forward of that demand. And so, we're also seeing an increasing number of tech companies talk about layoffs or hiring freeze. And so we're still neutral on the sector. Valuation, of course, has come in quite a bit, but this is a sector that's still trading at a 20% premium. Pre-pandemic, that premium was more like 5%. But I will say that there's still some areas of tech that we find interesting at this point that are more tilted to those longer term secular trends, whether that be artificial intelligence, big data, cybersecurity, automation. So there might be some opportunities there.
Nadia, it feels like the yield curve and investors are kind of looking at that recessionary fear, right? Hike now, pay for it later. And if we get into that recessionary environment and that fear goes more mainstream, growth is going to be a lot more scarce. Is that how do we know when it's going to be time to buy tech to protect against that kind of scenario?
A recession isn't our base case, but of course, the probability of recession continues to move higher. Like in that sort of scenario, as we're coming on the other side of it, then I think that tech becomes more interested. But right now, we also looking more closer to the value side of the equation, which tech doesn't fit. Because when you look at the historical data, in periods of inflation above 3%, which we can all agree we're going to be in that range for quite some time, value tends to outperform growth when we know that tech tilts more towards growth.
And I know that on that front, Nadia, you're looking at defensives and quality, and one of those areas you focus on is energy. Where in the energy space do you think you're going to see the benefits of the disruption that we're seeing in many of the underlying commodity markets right now?
Within energy, of course, we, continue to rate where our buyers on this pullback. I think within energy, given the long period of underinvestment in this space, we're looking at the oil services company. We're also looking at liquefied natural gas. We see the crisis that's, upon us in Europe. And so we think that there's going to be increased demand for that. And so those are the areas, and some of the refineries, just given the spread that we're seeing in the marketplace, those are the areas of energy that we particularly like at this point.
Hey, Nadia, I want to bring the attention to Bank of America Fund Manager Survey. It's always a fun one to check out. And this one was particularly interesting. And this was for the previous month. But they say that investors are in full capitulation mode. They talk about a dire economic outlook. Cash levels are at the highest since 9/11. Equity allocation is like we haven't seen since Lehman collapsed. Biggest longs are oil, dollar, and commodities. What's your takeaway from something like this? Have we seen capitulation? Do we need to start thinking more counterintuitively?
I don't think that we've seen full capitulation. Of course, there's debate in the marketplace as whether we're heading towards recession or a soft landing. That will take some time to work itself out. I mean, quite frankly, now this downside scenario for the S&P 500, which assumes a mild recession, and we know those probabilities are going up, we're looking for 3,300 on the S&P 500. And so we could retest those recent lows that we have seen. So we don't think that full capitulation has happened yet. But at the same time, doesn't mean that there aren't things to do in the market. You're seeing in the manager survey that position in energy. I would also highlight healthcare on the more defensive side in this marketplace as you sort of wait out and see. There's been some noise recently around drug pricing, but we ultimately think that will be a clearing event. And this is a sector that consistently has the earnings growth that you're looking for in this marketplace.
One of the other big themes we've talked about a lot recently, Nadia, has been the strong dollar, and that's starting to have an impact on the earnings reports we see. We saw that from IBM talking about strong dollar. That's a business that, of course, does half of its business outside the United States, and so that translates poorly from other currencies back into US dollars. Is that going to be something that's going to hurt big US businesses with those big global footprints, Nadia? Is that going to be a theme worth watching through earnings season?
Absolutely. The dollar is at a 20-year high. And so, those companies with ex-US earnings, particularly tech and healthcare that are more exposed relative to the rest of the S&P, that's going to be a near-term headwind. So probably a couple of percentage points being shaved off of their growth. But in our core view, we think that there's limited upside to the dollar from here. We actually moved more recently to a more neutral view because we do think that as the economy in the US slows down, as the Fed comes closer and nearer to the end of its hiking cycle, then you should see some of the pressure, the upward pressure on the dollar relief. I mean, we're looking for on the 10-year 3.25, and we think that the Fed funds rate is going to peak at 3.25, 3.5%.